Welcome to the Acid Capitalist podcast. My name is not Hugh Hendry. If you're watching on the YouTube version, you may think it is, but it is not. I am the alchemist, aka Chris Sweeney, and I am wearing one of these fetching, sexy, alluring, designer Hugh Hendry signature hats. And I will bring the man himself in, the Acid Capitalist, the man that can see around corners, the man this podcast is named after, the reason why we're all here. How are you, Hugh? I hear you're not in St. Bart's. You're somewhere a little colder.
I'm in Scotland. I'm in a hotel in Scotland. I'm going to be presenting tomorrow in the Adam Smith House. I'm going to be part of the Edinburgh Festival. And to your point, Chris, I think we've got to get you a wig. I think the hat always works better with some hair. But please, people, acidcap.com. Go out, be bold. These aren't hats. This isn't fashion. This is making a statement that you care, that you get it.
Or you don't know who you are in my case. Or you've got your identity mixed up with someone else.
Hey, listen, it could say Giorgio Armani, right? What has more resonance? What's going to change the world? Okay. And you look behind, look, we've got them all. We've got them all.
The full range.
I've got to be careful. I've got to, like, for the Celtic community, we've got to be green. I've got the blue ones, but
you've got all sorts. Yeah. And what's really good is I'm seeing people online wearing them. I'm seeing people from around the world posting and stuff like that, which is quite interesting.
Please send as many pics as possible, and we'll put them on our various platforms. So what are we doing today, Chris?
Well, today we've got a guest back, and he's not back because we want him. The audience want him. Everyone wants him. We're having a bit of Rampaging Russ, as he's known to his friends, but more importantly and more formally, he's known as Russell Clark, hedge fund manager. We had him on a few weeks ago, Hugh, and we want to get him back. Isn't that correct?
That is correct. Macro on macro.
So can I give you an idea, which I think will melt your mind?
Okay.
If you're ready for that.
Let's do it, Russell. Melt our minds.
So I've been thinking about this political cycle, right? And because, we're based in Western Europe, and what we get taught history, we always look at Volcker and we look at Reagan and we maybe look at, FDR and all this sort of stuff. And I was thinking, if I was like a Martian coming down to Earth to study Earth history, and they said, okay, you need to look at one country. One country might give you an idea of how that world is changing. And I really do believe the world is actually all joined together. One part affects another part quite strongly. If I was a Martian, I'd say, well, we should look at the most populous country to get an idea of what the world's doing. So they'd be like, go and look at China. Okay. Now just bear with me on this. Okay. But right. So if I look at Chinese history, so from the sort of 1800s through to the end of World War II was basically an era of conflict and basically sort of imperial land grabs of various parts of China, and China was in a very sort of deflationary bust type thing. And then as World War II ended, the communists won that civil war, and you had the implementation of extremely socialist policies, collectivization of land, all these other things. But actually that was also happening in India, which is also a very populous nation. So you had this half of humanity was moving to sort of a socialist, more than half. If you look at the population share that was under communist or socialist influenced rule after World War II, it was like 80%, 70 to 80%, right? And so that was what was driving this inflationary cycle, because socialism and communism is inherently inflationary, just by the way it's structured. And then, and here's where it gets interesting, is Mao died in 78. And Deng Xiaoping came in. It took him a while to kill all the lefties, move them out of the way. But 82, we suddenly had these huge market-based reforms. And one of the first things they did was devalue their currency massively, all through the 80s, which was basically a way of saying, we don't care about workers' wages anymore. We care more about profits when you devalue. And it became more and more capitalist. And if you went to China during any of that period, every time you went, it was more and more capitalist, more and more free. And I'd say that continued and was still the case up until around 2011 to somewhere around 2015, when I think Xi came in 2011. And again, a bit like Deng Xiaoping, took him 4 years to get rid of all of his rivals. And he suddenly went, you know what, this model, the capitalist model, which would now imply that we need to devalue to make our workers poorer so we can be competitive, that doesn't work for us. I don't like that model anymore. We're going to go back to the old socialist model. And what you've seen is a sort of creeping socialization of China. Capital control was a big change then in 15, I think, which was a real mark of that change. But now you've seen it like, Alibaba, how much money have US investors lost in Alibaba when the argument was, this is the most powerful company in China, the government must support it. Otherwise, why wouldn't they? Because that's the American mentality. Big corporate must be supported by government. China said, no, Alibaba doesn't do anything special. It just concentrates capital. We can dismember this company and we'll still get all the stuff we want. And they've done the same with property developers, which I think is very interesting. Because again, I think they're focused on what is really the big point, particularly in the UK, is property is too expensive for most people, right? It is. It's just a fact. It's an absolute fact.
Of course it bloody is. Of course it bloody is. But they designed it that way, I
know, but that's why it's not popular. It won't win votes. And Boris Johnson was an exact example of that.
He ain't going to, I tell you, if I was them, I'd be shit scared because it kept them in power. It kept the wolves away. Confuse the people, make them feel rich. Have property prices going up every year. The idea, I have to say, so much I'll take and listen to, but the idea that the Chinese autocrat stepped in and decided to prick the bubble of property by design, good luck with that, because they sat there and they destroyed wealth to create GDP because they believed that GDP was the register that kept them legitimate and therefore kept them in office. And GDP growth became impossibly difficult post 2008. Why? Because their trade surplus with the rest of the world amounted to 1% of the GDP of the rest of the world. And historically, it's really hard to expand that beyond there. Not impossible, but hard to expand at the same clip, which would generate about 3 percentage points of Chinese GDP. And so they themselves flipped into the two erroneous missteps, which was a commitment to gross capital formation, which we call railroads, fast rail, bridges, you name it, airports, etc., where the net present value of the utility of future consumption, the ability to transfer citizens from point A to point B and take 1 hour out of that journey. If you are earning $50,000 and you can save an hour, the utility function of that is enormous, and that would therefore generate utility dollars, if you will, in excess of the $10 billion to fund the scheme. All of that thinking went out of the door, and it wasn't enough for them to actually get their committed GDP growth, which always had 5+. And so the other misadventure was we need the property construction because the GDP contribution is so immense. These two together were a third of all Chinese nominal GDP expansion since the fabled days of 2008. And that wealth thing, which they entertained, they could have cut it off years ago, but they allowed it to get to $90 trillion. And at $90 trillion, you don't go messing with that thing. That thing is, for them, having allowed that to grow unchecked, I think they've lost control. I know you're the other side, Russell, so come back again.
No, I mean, I used to be super China deflationary, but if they'd followed the sort of roadmap of every other country that gone to that problem, they should have devalued 5-6 years ago, and that would have solved.
Revalue, Russell. They should have. This is the fundamental difference, especially with regard to your introduction, which is socialism, the widespread socialism, and communism, which followed, in the 30s, the 40s, etc. A revaluation is how you make the citizens wealthier A
agree.
devaluation makes, and that's where they are at odds. That, to my mind, the tension with Taiwan, etc., is a symptom of the fact that China has taken all of the gains. It's been able to go from, a piss poor country, excuse my French, to being a minimum of $10,000 a year, which is still in our world nothing, but it's a huge advance. And at this point, given the productivity that's been brought to bear by their masterful investments in these conurbations and transport links that are the envy of the world, and I congratulate them on an amazing job. Their current, you talked about the devaluation. The devaluation, I want to say, was 1994, and they devalued to 8, right? Well, here we are, and it's almost 2024. And where are we? We're 675. That is absurd. We should be trading for the rights of their working class. The renminbi versus the dollar should only require like 4 renminbis to buy a dollar. Then their system would be working. Then we wouldn't have a surplus of global savings. Then we wouldn't have these speculative, crazy markets. We wouldn't all be speculators, we'd be entrepreneurs, and we wouldn't find ourselves in a depression. So boom, back to you. Hit me again. Come on.
All I would say is that you're looking at the dollar renminbi exchange rate. Then, if I looked at something like the yen renminbi exchange rate, it's appreciated quite a lot. And if I look at the
no, it's completely gone back to the devaluation has all what I want to say that the advantage from so I'm agreeing with you. The advantage of that devaluation has been eliminated by the weakness of the yen. Forgive me. Yes.
And what has been very unusual, and this is, I think, really I personally is a more criticism of Japanese policy. Right? If you looked at Japanese per capita incomes and looked at them at Chinese, you would expect the tourist flow to be all from Japan to China, right? But actually what you see is reverse. It's all Chinese, well, pre-COVID anyway. It's all Chinese going to Japan, saying everything's cheap and buying stuff. So while the exchange rate didn't appreciate as much as it should have, they certainly had enough of an internal revaluation higher, particularly in incomes. Because if you went back to like the 90s, right, Japanese property was here, everywhere else was like nowhere, absolutely nowhere. You could buy everything in Shanghai. I was in Shanghai in the early 90s and now again in 98, all through there. And until very young, in those periods, property was dirt cheap because no one trusted the Chinese government back then. So the internal valuation has been very, very strong in China. It just hasn't really been the exchange rate. And typically what you've normally, like the Japanese policy is the one that doesn't make any sense to me. Deliberately going out and impoverishing the average Japanese person and continuing to do so. It's something I don't really.
I wonder if it's. I was going to push back and say, I wonder if it's a policy of the Japanese bureaucrat, or it's you and I and the private speculative community thrashing it out with regard to the inflation debate, with the control of the yield curve, and so the impossibility of moving the yield requires a different valve outlet, which becomes the currency. And I'm unsure about that. And I'm unsure about that because whilst we began with I keep calling it long monologue. I don't mean that disrespectfully, and thank you for that. What I mean is that I reduced it into just one cycle between debtors and creditors, and agreeing with you that cycle is beginning to lurch, but that it will take 40, 50 years. And where we disagree, I believe, is I think in the next 2-3 years, you could see profound, absurd drama whereby it all goes the opposite way. I actually fear that I would not be short bonds. I don't share your notion that bonds are super stoked, super loved by the investment community. And when I look at commodities and how commodities have performed this year, commodities are are sending out really concerning signals. And I think the biggest concern is with the state and the health of the Chinese economy. So it's a bit like where I was in 2005. I was saying, if you think the future is inflationary, buy bonds, because it's only when, for that to come true, I was saying that the Fed would have to go to 0% interest rates. And for the Fed to go to zero interest rates, you'd need a depressionary event. So let me be more constructive. Do you, given your knowledge of China, what probability assessment would you give to a devaluation in that? It's principally accorded via the dollar renminbi. What probability do you see of it happening, and what level do you believe would be judged appropriate?
So this is I think, I was saying to you, I've been looking at the euro because everyone's talking about the euro and where is the euro going? Why is it so weak? And the weird thing is that every argument when people talk about the euro, you can easily disprove. So, for example, the big argument is the spike in natural gas prices destroying the current account surplus. But if that was what was driving markets, then we would expect currencies like the Aussie dollar or Brazilian real to be shooting higher. It's not. The thing I find very unusual is the euro in yen terms is actually near cycle highs, 10, 15-year highs. And if you look, it's really yen weakness seems to me acting as like an anchor pulling down against other nations. Because if you look at something like the Korean won, it's also very weak and much weaker than the renminbi. So when you talk about renminbi weakness, I could see the renminbi weaken a bit if the yen continues to weaken, but that would mean on a trade basis, it's actually still strengthening. So when you just look at that dollar renminbi exchange rate and you ignore the euro, you ignore the yen, you ignore the Korean won, yeah, we could see a devaluation, but it'd be a devaluation that doesn't mean anything. I'd also say, historically speaking, normally the markets are pretty clued up on that sort of stuff. So if they think a devaluation is going to come, I would have expected the long end of the bond market to be much, much better behaved. In fact, even rallying, because they would see proper China devaluation, the one you're talking about, super deflationary in that. And weirdly, not even the long end of the JGB market is particularly acting in a deflationary way. And the Japanese bond investors have been 100% correct for the last 40 years, even as everyone else in the world has been like, I've got to sell JGBs, and have lost their absolute shirts on that trade. You have not seen that.
I think you give those Japanese boys a little bit too much credit. I think you're talking about investors that had no discretion. I think investors, both Japanese and overseas, that had discretion, all were subject to the same folly and the same error. I think with regard to the performance of the long end of the Japanese bond market, conveying any information, I don't believe it does. I think that the tradable size of the long end of the JGB is immaterial. I welcome the discussion about the euro and its weakness. Chris and I were quite early in going out and saying a generation of European political leaders forfeited the right of Europe to have a sustainable, perpetual-like supply of energy. Energy is our joy. Energy is, I keep just think, if you eat a croissant, there's 200 calories, and trying to burn 200 calories on an elliptical machine and give yourself,
easy. It's not easy.
20 minutes, Chris, yeah, and you sweat. And
it's not easy.
The revolution in the life of the human being is the creation of electricity. When you forfeit your perpetual right and guarantee to an energy source like the Europeans do, you forfeit sovereignty, and the currency has to reflect that. But beyond that, there's quite an interesting minor cacophony of Twitter threads that I've been seeing, and really relating to the role of BTPs, the Italian 10-year government bond. And they're either the third or the fourth most heavily traded government bonds in the world. Which is Italy? Really?
Yeah, it's a big bond market.
It's big. Now, why is it so big? It's so big owing to the Draghi comments from 20. How late did he say you will do whatever it takes? Was it 14 or before? Was it 12? Maybe it's
around that period, 13 or 14, I think.
13 or 14, right? Where you give it the investiture of the ECB and you make it, you give it conceit and arrogance. It becomes a risk-free security. And the
26th of July, 2012.
2012, right. It makes me, so we live in a world, again, where only 5 people truly understand finance and money and how money works. And the principal source of lending is no longer savings, sight, or time deposits. It is banks being unregulated by financial authorities. It is banks being regulated by their engagement with their peer group, by being judged by their peer group. And if their peer group are willing to accept their collateral, then they continue. When their peer group gets a concern about them, they get shut off. So it's a world without central banks. It's a world that self-regulates, and the collateral of choice is government bonds. The collateral of choice would be German bonds, but the Germans actually in their constitution they can't run deficits. They've got a balance, which is to say there's just not enough collateral. It's like the fault of moving back to a gold system to regulate the expansion of money. We would be in a profound depression because there wouldn't be enough gold. If it was all regulated on 10-year bonds, we'd be in a depression because there's not enough bonds to put out as collateral. And so what happens is, well, okay, there's not enough bonds, but actually, when was it, Chris? July 2012, BTPs become the de facto bond. Now, the currency and why it's moving, yes, the natural gas, and the natural gas is huge. So let's just recite again. European households are paying the equivalent of $600 per barrel of oil to heat their homes, and that price is likely to go high. And the price of oil today is $90. So that is huge. But the ECB's had to step in, and maybe we'll put the chart of the spread between the 10-year BTP and the bond, and it's not exploded, but it has traded as the tights have been run about 100, 110, and I think it's traded recently as high as almost 300, and then with some verbal and vague language, they brought it down to around 220. And they've said, listen, we won't buy bonds, we won't buy Dutch bonds, we won't buy French bonds. We'll continue to underwrite the periphery. But again, very, very uncertain language. And then you've just lost Draghi, and you've got, again, the possibility of, what did you describe it as, Russell, when you said, what did you describe Brexit and Trump-like manifestations of anger, did you say? Or
populism, or the shift away from favoring capital to labor,
Right. So the great danger is if we get another of those shifts and the Italian population say, we don't need, stop interfering with our illogical. I mean, Brexit it's not fact-based. It's emotionally, it made some people feel better. Okay, I'm not going to judge it, but except to say that it wasn't factually based. And heavens, if that happens, it will reveal the conceit. The conceit today in the modern financial world, the entire financial world, from Beijing to Brisbane to Bordeaux to whatever, forgive me, to Birmingham, I'm going to stop with the B's, is that BTB. It's a little bit like 2006, 2007, that you could hold MBS. You could own you could collateralize a collection of US mortgages selected from with geographical diversity because they were actually safer than US government bonds because you would never get a nationwide household cycle to the downside. And what we've invested since the great financial crisis, we've just gone on to repeat the investiture of a conceit. And if it's revealed via a political decision by the Italian citizens themselves, then the system will fracture again. And so I think it is fracturing. What do you do? If banks at the margin are saying, these BTPs you gave me, Hank, these BTP, I don't feel as comfortable. And to keep your credit line, you're going to have to take them back and you're going to have to give me US treasuries. Now, what's happening at the margin? You're selling euros and you're buying dollars. That's what I think you're seeing this year in the cross rate. I think that more than the natural gas. I don't know what your pushback, Russell, is.
I'll just say that I think the world has changed a lot from the 06, 07. I think the cornerstone of that crisis was that, and it's unbelievable to say it now, but I remember in 07, Greek bond yields trade inside German bond yields because Greece was growing so much faster than Germany. People were like, no, these are much better quality bonds. And there was this implicit guarantee. And when the market suddenly questioned this implicit guarantee, they went to the Germans and said, so you guys backstop Italy and Greece and all these guys, right? And they went, we never said we backstopped them. And then, of course, it dumped, and then the ECB had to come in. Well, I would say the big difference now is that COVID saw the issuance of a mutually backed euro bond, right? So the governments have gotten together to mutualize bonds to a degree. And I think the other big difference now is Russia and Russia's invasion of Ukraine has given a new political impetus to the EU project, which is one of unity in face of an enemy to basically banish war from Western Europe, if possible. And so I would really be surprised that even if they vote, a hostile government, what I think that hostile government will do is they'll manage to get more money out of the Northern Europeans. Because I think the Northern Europeans also realize they need to spend. They can't just sit there saying, oh, no, you can't spend money. You got to pay it off yourself. They know that that is not a working system because if they do that, they're just making allies for Russia and other sort of more hostile powers. And China, if they want to put China into that back bracket. So the politics has completely changed. I think the support will be there, even with, a crazy government in Italy. And I think, for me, whenever I start thinking about big trades, I think about politics first. Is this going to fly or not? That's why I don't think you're going to see a recession particularly, because I don't think any government is going to get reelected with a recession. I think what governments may get reelected with is policies to, boost wages and bring house prices down. Tax the rich. I think that's also popular.
What I was going to say when you were talking about politics there, and I mean, Hugh's going to face this problem tomorrow as we record because Hugh is travelling to the great city of Edinburgh to be interviewed and do his stuff in front of a panel of experts and financial gurus, etc. But
is this like a financial fringe festival or something like that?
Yeah, it's part of that. He's going to the Adam Smith house to be interviewed. It seems very. The thing I want to ask him actually, Hugh. Well, I'll bring my point up a minute, Hugh. You don't wear suits anymore since you stopped managing hedge funds. Will you be going in a suit to that? Because you can't go surely in the St. Bart's wardrobe. I don't think that's going to fly at Adam Smith house, is it? Have you brought a suit? Have you got a shirt and tie in your suitcase?
I do not have. What's wrong with?
Are you going to go St. Bart's? Are you going to go St. Bart's style?
Yeah.
Okay. Well, I don't know. Let's see how that goes.
Here's a question. So we're presenting at the Adam Smith House. Please, if you're in Edinburgh, it's the Panmure Gordon are the sponsors. I believe kickoff time is, I think,
2 p.m.
Doors open at 1. Yeah,
but there's tickets. It's not a free thing here, people. You're not gonna get Hugh to dance for free. It's ticketed. Am I not right?
I don't get any proceeds from it, but I believe it's sold out. But I'll be available. DM, put a message on.
I was banned. I was not allowed. People, Adam Smith, they did not allow the Alchemist to attend. So the Alchemist there's a restraining order around that building. So I am not welcome.
Yeah, they're like, you don't need any fantasists who make up stories like that. But so here's the point to you, Mr. Alchemist. They've asked me to begin with famous reminiscences or Adam Smith quotes, and you know my history there.
Tricky, yes, tricky.
No one else does, but it's got to do with beavers. Russ, I don't even know if this is true, because I read, people do Shakespeare and they'll read Shakespeare with one of those, what are they called, Oxford kind of those explanation study guides. I read Wealth of Nations via the US political satirist who died this year, and whose name I can't remember now.
P.J. O'Rourke?
Yeah, P.J. O'Rourke, thank you. And I don't know if he was making it up or not, but apparently, because 17th century, Adam Smith was trying to, and I'm not going to, Chris, don't worry, I'm not going to do the grotesque version of this. I'll keep it short. But Adam Smith tried to explain the advantages of a fiat monetary system by comparing it to a system which used beaver pelts as a store of value. I'll leave it at that.
Yes, well, we will. Yeah, he got himself into a bit of hot water in front of some quite influential people as you launched into
It was another Drovny conference, and
he got carried away. But anyway, but the point is, he's going to Edinburgh tomorrow. So my point was politics. I was going to ask Russell about this. In Edinburgh, they've got a huge strike at the moment with bins. Bins are not being emptied, and the bins are overflowing.
What are bins? You mean refuse? You mean?
Yeah, I mean garbage. I mean trash. I mean garbage. I mean things like that. Yeah. So there's a huge problem, and we're seeing it in London. Russell and I live in London. There's train strikes, and I'm reading 70% people are supporting these. We're seeing over in America, I know it's very small, but some Amazon warehouses are forming unions. Are we going to, how's that going to play in? Because it seems like unions are coming back. And you mentioned how in the 70s they were corrosive, but it seems like there's a movement to bring them back. And you're saying, a recession can't happen. So do unions have got a part to play? Do you think they're going to come back? How do you think that fits in politically?
Absolutely. I think, when I look at Brexit, the idea was to staunch the flow of Eastern Europeans into the UK, so that you could create, rising wages. And Trump was definitely anti-Mexican immigrants coming over to work. So there is a political vote in pushing up the wages of the lowest paid to try and reduce that income inequality. And the one thing I've learned in my 48 years on this planet, I used to think there was a right way to do things, and if only politicians did the right thing, everything would be great. All I now know is politicians do whatever they need to do to get elected. And so they are purely reflections of what society as a whole thinks is the right thing to do. There's no right way or wrong way. There's just what wins elections. And winning elections now is about keeping unemployment low, getting wages up, and I suspect trying to get, to try and reduce that income inequality. So it's definitely a shift to the left. And I mean, the problem with that view, and this really is a bad problem, is I think it makes investing incredibly hard, because essentially we are in it's an environment where we're trying to peg back the winners and boost the losers, which means you need to buy losers, and no one loves buying losers. Everyone wants to buy winners. Everyone wants their portfolio to be all the best stocks. But those are exactly, and China is a good example of this. Everyone was in Alibaba, Tencent, all their tech companies, because they said these guys are the winners and they're going to win forever. Well, the Chinese just came out and crushed them. And you're starting to see the same thing happen in the US. If you look at what the FTC and the other sort of organizations that enforce competition rules are doing, they're looking to pick apart these businesses, to try and peg them back a bit. I think that's where we're going at the moment.
But
so
aren't you surprised? Because you did knock me back a bit. I thought it was a huge statement. We won't have a recession. And we won't have a recession, to your point, because it's not in the politicians' best interest. But like, life doesn't. What was fascinating is the volatility machine that we continue to build, which resulted in the tech crash of March 2000, which resulted in the catastrophe of the Great Financial Crisis, 2007, 2009, biggest nominal real GDP contraction in 50 years, and which continued into 2015, 2018, 2020. Is that the problem? Because you're talking about debt being 4.5 times going to 5, and that's just one measurement of it. The problems are actually greater than either the resolve or the ability of the politicians to respond. I mean, there's a political face-off between the governing party in the United Kingdom just now, between two idiots. I mean, neither of them have the intellectual ability, and they don't seem to have any advisors giving them any potency to deal with today, and they're not alone.
One was a former hedge fund manager, just for the record.
He was a lanky that worked. He went through a door and it said hedge fund. Didn't have his name, right?
Okay, he was a hedge fund person.
15 years of managing risk. Yeah, he was a guy. Made some coffee. He probably was a really nice guy. I know his type. So I put it back to you again. And especially in the context of China, and especially in the context of your bullish call on commodities, that I say to you that the situations confronting the world today are greater than the ability of politicians to respond to it. And finally, actually, even we had COVID, we had the election of the Democrats, and they couldn't. Actually, the Democrats couldn't get the votes within their own party for a $3 trillion expansionary fiscal policy. We're not building airports. We're not replacing terrible infrastructure. You've got bridges falling down in America, and you've got a Democratic Party. It's not there. So what do you think? And as you said, I'm going to attempt to bring up a free web page, and we'll kind of look at some of the commodity prices, and we might get your opinion. But again, Russ, over to you.
Well, I would just say, can you name a big recession that happened in the 50s or 60s?
Russell, you're in there with a gauntlet. You've laid the gauntlet down to him. I like this. We're getting a bit spiky here. I like it.
All I can say is I can name recessions in the 70s from the oil spike. Yeah, sure. And the 80s and 90s loads, 2000s loads. But what I'm trying to say is a recession was a change in that political ideology, is that, yes, we can screw workers over, but screwing the workers over will keep commodity prices and inflation low, and the cost of credit low. But when you change that to, what I'm saying is you can drive growth, and we've seen this in COVID, seen this year. If you give poor people money, they will spend it by definition. Rich people save and poor people spend. That's why you end up with that big difference, right? And it's just by definition.
By definition.
So when you give poor people money, they spend. And you look at what happened in COVID, right? COVID, I was thinking, why is the market up so much? I mean, this COVID could wipe out a third of the population. Right? Surely you should be worried about it. But if you looked at the flow of money, which was basically these huge stimulus checks going to poor Americans, and I must say, this student loan relief thing is a big deal. So I have some American friends, and they said, look, every month, because they take the money out before you even get it on the student loans. It's like it's like a tax almost. They take it out before, so you have no option but to repay it. They said, I'm not paying anymore. I just get more money in my paycheck. And now they've made that permanent and expanded it. So what I'm trying to say is this is giving poor people money is actually a very rock solid GDP growth model. The downside is it creates inflation. And I think what's going to happen here, right, is I think there's going to be a asset recession in real terms. Nominal terms, not too much. So I don't expect my property in London to appreciate much. It'll stay around where it is for the next 10 to 20 years.
It's also your property in London's kind of the same property value as it was 10 years ago.
Oh, might be. I don't know. No, I'm not sure about that.
No.
Maybe. I don't know. No, I think it's gone up, especially recently. But
saying versus 2012, certainly versus 2015 or so.
Maybe, yeah. It's a tricky one. But what I would say is I think, the more I'm really bullish on this, so we've got a babysitter, had the same babysitter for 10 years, basically paid a 10 quid.
You're not bullish on the babysitter.
No, we paid a 10 quid 10 years ago. We probably pay about 12, 13 quid an hour now. I reckon in 10 years' time, that's going to be 30 to 40 quid, maybe even more.
But my question is, for both of you, what's a poor person now? Because we're seeing such, of a cost of living. I've got neighbours in my building, and I wouldn't regard any of us as poor, but, people are having to make tough choices. They're saying like, I can't afford this, I can't afford that. I mean, what is a poor person anymore? I mean, it seems that definition has changed.
It's tricky. You can be asset rich and income poor, which is a problem. I don't know. It's a tough one. But certainly, I don't know. The number is tricky because, like in London, you do, what's average GDP per capita in the UK is supposed to be like 25K. But I think, most people would struggle to live in London on, less than 60K.
Yeah, London's $75,000 GDP per capita. But, that would be pre-tax, I think. So after tax, you would be, down at 40? And then you're talking about energy bills of what, Chris, 4,500?
Yeah. Well, I mean, that's what they're thinking, but I mean, it could go higher next year again.
And it will go higher. So that's 10%. Immediately you're losing 10. To Russell's point about, recessions. What was it? Did we have? Can you think of recessions in the 50s and the 60s and whatever? We had the wonderful Danny Blanchflower on last week, and he was just saying that we went through something like 27 years where it's like GDP quarterly was just, it can't be 27, 17 years where GDP was always revised higher, right? Yeah. What was going on? We invented the Eurodollar system, that collateral-based system where you're regulated by your relationship and your prudential relationship with other counterparties, and you took the shackles of government interference and banks lent money, and we created a lot of GDP expansion, and we enfranchised people. We made them rich. It's that system that is my fear. So let's look. I said let's because people kind of always like the idea.
Is this the Hendry stock rotator thing that used to we used to do this, Russell? We used to bring up charts and he would just give us his immediate here. That's my personal messages. Get them off. I'm pouring out my soul to you. I'm telling you about my sex life and whatever on there. Get that off.
It is off, Chris. Yeah, or are we still looking at it? I'm looking at financial charts.
Oh, we can see the charts. It was just my personal stuff just flashed up for a second. I bet there's these perverts online that are going to be pausing that and looking at what I confess to you. It's like a priest. Okay. No, it's okay. There's nothing on there of great interest.
I'm trying to move it to weekly, but let's crude oil. Let's bring up. See, here's a nice old. Why is this not? I don't seem to be engaging with it. What's happening? Well, let's crude oil $125 down to 90.
So I'll talk about crude oil.
Copper $4,000 down to 3,200. The soft's taking a bit of a hit, but dollar back at its high, yen's still on his ass, and stocks have had the best part of 2 months rallying.
So crude oil is a good one, and that's the big one that really counts. Natural gas prices, of course, are at highs, and so are the forward curves. Now, crude oil is fascinating for me. So, you're probably familiar with the Strategic Petroleum Reserve in the States.
Yes, we talked about it to Tracy Shukart a few weeks ago.
Okay, well, basically, they've been dumping that at a rate that has never been seen before. Right, absolutely dumping it. And so what's happened is they've loosened up So if you go back to the beginning of the year, the 12-month spread, so the front month versus 12-month spread in crude oil was the steepest it ever was, which basically is a sign saying, we need oil. We need it now.
You need it now.
And so the government came out and they dumped it, and that spread has collapsed. There's done nothing on the 12-month. The 12 months has stayed pretty flat. It's just that front month illiquidity has dropped down.
I don't know, Russ. It's getting close to contango in the back months.
Last time I looked, it was still a $5 spread, which was outside of the recent one. It's still quite wide.
And if it does, I mean, if it goes contango, I mean, that's a big statement. But anyway, continue.
So that is the one thing. The other thing.
Can I just ask what quintango is? I'm very sorry to interrupt, but I am the idiot in the room. What does quintango mean?
Contango, but I'll leave that to Russell.
It is, so that is when the front end trades below the long end. All right. And it's a sign that you've got too much oil. All right. So
you're leaving it's a financial reward to store the oil. It's like the consumer saying, I don't need it. Take an extra buck to hold it. Hold it for me. I don't need it. Okay,
thank you.
So the other thing is
are more expensive than the shop.
And the other thing that's very unusual about the oil market is that you can get very good data on drilling activity in the States. Now, drilling activity has increased a bit, but actually they spend a lot of their time just working down this inventory of old wells. So the inventory of old wells in the States has fallen by half. It's all public information. If you want it, DM me, I'll send it to you. So what you're seeing now, and this is the thing I think that's really interesting, is that the shale boom was driven by a whole bunch of independent wildcatters going nuts, and they massively overdrilled. What's happened over the last few years is they've all been consolidated, and you now have a sort of mini OPEC in the States where 6 producers control most of the land for shale drilling. And they're now really squeezing that market because basically they got tired of losing money hand over foot.
Well, hold on. Because this is the Texan hustle. This is my interpretation of that. I put this firmly. So I agree with what you're saying, first of all.
Okay.
But I believe that it's not an OPEC private producer monopsony kind of thing. I put the blame at Jay and the Federal Reserve, Jay Powell, in his preemptive hiking in 2018, which caused the stock market to fall 20% and which caused the high yield credit market to blow. The high yield credit market finances those exploration companies. They went from trading on $1 to trading at 25 cents. And the culprit is both the environmental social governance and the elephant memory of the losses incurred from overreach in terms of exploration. And I put it down to the Fed and to BlackRock, who are saying, guys, you're not going to explore, you're going to preserve your cash flow, and you're going to repay me. And that is a circle which is creating tightness and reinforcing, and we should see prices higher. I agree with your SDR thing being an issue, albeit I do have to also reflect that it is a surprise that US mileage is still down.
It's a surprise.
Yeah.
I am trying to, I don't think that, because what I'm looking at here is like the inventory of drilled uncompleted wells, which is what a lot of the shale drillers used to do, basically to mark the area. And what you can see is that peaked, for some reason, I'm not making a graph, that peaked in June of 2020, believe it or not, and at 8,800 wells. So quite late, and it was rising through 18, 17.
Yeah, but that makes sense because they had all that, they had a huge credit raising cycle.
Oh, yeah. But it went beyond 18.
And, from 18 to 20, the bonds slid from $1 to 25 cents as they had to kind of unwind and stop it all. And then since then, it's been, it's like, guys, don't spend it.
I think it was more the negative pricing on oil and gas in the States. I think that's what really blew their minds.
I give you
that would be like, we can't get rid of this stuff. You have to pay someone to take it away, I think is what really brought the discipline in more in the credit market.
Mm-hmm. So oil is the right price, or you're saying the SDRs and whatever, there's an artificial depressant? I mean, so where are you on oil?
So look, I made a ton of money showing commodities from like 2011, 12 onwards. What basically I did was the first one I found with oversupply was iron ore, made tons of money on that. And then there was coal, and then oil, basically in that order. And then after that, it got trickier. The market became much more difficult. But the big driver of all of that, I think what really killed people was that if you looked at the natural gas market in the States, it basically collapsed in the GFC and never recovered because the shale producers were coming in and they're crushing that. And what became a widowmaker trade in the financial community is people kept looking at US natural gas price and saying they were too low relative to the oil price. So they kept buying natural gas, but the supply was there, so it kept going down and down and down. And for years, it was basically if in the Permian, so you can get Permian pricing with natural gas, for example, was $0 or $1 or $2, very cheap. And so you always had this pressure for oil prices to drop, right? For me, that's the way I looked at it. So there's always this arbitrage, and the arbitrage is going to go the way of where supply is coming. So if supply is coming on, the arbitrage is going to be down to lower prices. Now, what I can tell you, natural gas, particularly US natural gas, is a very volatile one because it has that seasonality. So what I can do and what I look at, I turn off my Bloomberg terminal before I do this because I don't want those ding noises to come in when people send me messages. But you can look, what I do to try and get a good idea of what's happening with natural gas is I look at the January future. So I don't do an NG1. What I do is an NGF23, that's January 23, or NGF24 for everyone on a Bloomberg terminal. And that just gives you the future for that January price for that year. And what is interesting is that keeps going up to new highs. And for very gray-haired people listening, back in the old days, the rule of thumb was that oil would trade at 10 to 1 to natural gas prices. Okay. On an energy basis, it should be a 7 to 1, but natural gas is hard to transport. And so what we've got now is there's no arbitrage between oil and gas. In fact, arbitrage probably the other way. Oil should probably go a bit higher for what gas prices are doing. And I can't help but look at like gas prices in Europe and go, there's another arbitrage there for US prices to go higher, right? So unless you suddenly see natural gas prices, not just in Europe, but in Asia as well, because LNG prices in Asia are very high, very, very high. Unless you see those two markets break, the pressure on commodities is continue to be higher, and it's going to continue to be that way. I don't see it breaking until governments are willing to let unemployment rise dramatically, and I don't see that either. So I just don't see that.
So that's great, Russ. Put that in Chris, let you speak to Russ. I'm going to just chill out. But put that, those NG, the January months, 23, 24 going higher, put that into the world of backwardation and contango so that people can understand. Put that in the context of the spot, what that message is from the marketplace.
Yeah. So, so the thing about natural gas, particularly in the States, is it's a very volatile commodity because demand increases massively in winter when the Northeast has to heat their homes. And so when people normally look at commodity pricings, they type in a code called, so for natural gas, NG1, which implies natural gas in 1 month's time. So it's the short end one. And we use that just so we can see what the current spot pricing is, more or less. Oil is the same, but oil does not have the same level of seasonality. And so for me, because of this natural gas price always spiked in winter, I want to get the underlying trend. So what I just do is look at a winter point in the future, and you get a much more smoother graph so when that NGF 23 first traded 10 years ago, and basically was a straight line down over 10 to 12 years. And what's happened since 2020 has been a straight line up like this, right? And what I'm saying is when I go and then look at the well data.
What does that mean? Like to the layman, what does that mean? The fact
it means natural gas prices are going to go higher into winter in the States as well.
In the future.
Yeah, the market is saying
independent, if you will, of the vagaries of the Northern Hemisphere winter.
What they're seeing now, typically when you're pricing it, and people should be familiar with it now because it's been happening in Europe, you look at the build of inventory during the summer months is when inventory builds. If it doesn't build enough, they start buying the January futures because they go, there's not going to be enough supply in January. But what is interesting about that market is very steep. So if I look at NG20, so I look at January 23 prices versus January 24 versus January 25, the front end is way above that. So it's implying there's a lot of scarcity of natural gas in the US, which is the one market where supply has been massively increased.
But doesn't that just imply that there's a huge demand from the US should be the marginal provider of gas? The rest of the world needs it. I mean, Asia effectively, the marginal price setter is Europe in its desperation. And so that just lifts the Asian curve.
Yeah, but you have seen a lot of, what I love about natural gas, it's good, it's reminded me I should go and rewrite this note, which I wrote a long time ago. So when you do a lot of commodities, basically you have like the Western world, China, and then everyone else is sort of like not that important, if that makes sense, sort of rounding errors. Weirdly, when you do LNG, which is the big tradable market for natural gas, when you start looking at the demand side of that, markets like Bangladesh, Pakistan, Philippines, Indonesia are actually together very, very meaningful, very, very meaningful participants. So what is interesting about that, and probably interesting for your podcast people, is most people are very bearish on Chinese demand. Property price is going to collapse, blah, blah, blah. I get that. I have no problem with that view. Their population is starting to shrink. I understand the logic of that. But when I start talking about markets like India, Pakistan, Bangladesh, Philippines, Vietnam, these markets, if you say to me their demand is going to collapse, I think, what are you talking about? Do you have any understanding of how little energy they consume on a per capita basis and have now started to become more industrialized? You then get an extremely powerful argument for continued tightness in Asian LNG prices as well. And so for me, natural gas, unless the state suddenly changes and starts drilling like crazy again, which I think is going to take a few years of very, very strong prices to change that mindset. And even then, I think it's going to be difficult because I think the big producers have basically monopolized all the best land in the States.
Well, it's also, like you say, it's gas is hard to distribute. And
it's very hard.
They keep turning down on environmental concerns, pipelines. And if you're going to ship it, you've got to get it to the coast. And then you've got to have the investment in LNG terminals and these things.
It's the terminals that's the real difficulty, because pipelines can be buried, and if you pay people enough money, but you can't do it with the terminals, and it ruins very expensive coastal, very, very expensive coastal views.
Also, strategically, it's like building a nuclear power plant in terms of it being a terrorist risk. I mean, heavens, So winter US natural gas trading at what?
$9 was where last I looked at.
So we multiply that by 10, and that's your $90, and that's what a barrel of oil is. And you're saying that the arbitrage, so that's kind of in keeping with your easy model, if you will, but you're saying actually the arbitrage opportunity is that I think if I interpreted you correctly, you're saying the crude oil price should be higher and therefore it should be pulling natural gas with it. Is that right?
Yeah.
And you believe the crude oil should be higher because you don't believe that monopsony of producers, the swing producer, they're just not going to be reacting to the high prices just now. They're going to be repaying debt or whatever.
Well, what I'm trying to sort of say is that we, for 10 years after the financial crisis, had a huge oversupply of natural gas. And that oversupply of natural gas acted like an anchor to all commodities to pull them lower, right? Because there is substitution. You can substitute natural gas for coal, you can substitute natural gas for oil, and natural gas is also used in fertilizers. So put a downward pressure on food, all the major commodities. And what I'm saying now is that oversupply is gone. All right. So the only way to really kill commodity prices now is a massive recession. And I see the politics of a massive recession as almost impossible.
Okay. And so the only point of disagreement then is a question of politics versus the potency of politics. And again, I find it I'm still the fact that we've had 2 consecutive quarters of GDP decline, which, folks, for as long as we've had economics, has been the understanding of a recession. And the Feds are going, no, it's not a recession. It's a mistake.
To be fair, I normally look for a big increase in initial unemployment claims in the States to really sort of say that's a recession.
That's their argument. Like, you don't get recession when unemployment is this low.
Which is a reasonable, I think, a very reasonable argument.
I just trust the numbers, and I know that revisions, they had GDP rising in the third, fourth quarters of 2007, possibly even in the first quarter of 2008. I think first quarter of 2008, they still were recording positive GDP for the UK.
Well, that's the great thing about inflation, is that you always have rising nominal GDP.
Yeah, but I'm saying 12 months later, when they revised the figures, we were in deep, dumb recession.
No, but that's why I think inflation is, I think the politics of inflation is almost, it's the only way I can see we can get sort of house prices to levels that don't create the social problems they are doing at the moment. They said,
yeah, but that's where, again, we come back to philosophically on the other side of you, that there's we haven't had the Weimar inflation, okay, in a proper is a jaundiced term, but in a mature democracy. Why? Because of, I think, the scale of public credit markets, the magnitude of wealth versus income. We were 7 times wealth to GDP. I think we've come down to like 5.5. But it's very, very sensitive on where you price the long bond yield. And if you do get your inflation, and you're talking about a wealth contraction via house prices. So if you get a wealth contraction via house prices and everything else, which is 7 times income, you will very rapidly fall into a depression and not an inflation. I
don't see house prices falling in nominal terms, just in real terms.
In real terms, okay. And then my other point is the raising interest rates. You went from 2 to 6%, or 2.5% mortgage rates to 6% mortgage rates in the States. But at the same time as the Chinese renminbi trades 6.75, and remember, it's only strengthened from 8 since 1994, and so ordinary folk have got less money and are shopping at Walmart because they've either had their income of their community displaced and replaced by a community in China, or they fear that that's going to happen. And every interest rate they pay, because everything's on credit, is being jacked up. These people are falling over. The only thing that's keeping the momentum in the economy is, the people unaffected by that class trade war, and who've had the benefit of those substantial appreciation in their wealth. I've been traveling the last 24 hours. Every plane's been busy. I went to I was going to do this interview in the lobby of the hotel, and they're like, every room is booked. We have functions. We've got people coming. It'll be noisy. So yeah, I'm in my bedroom. So clearly,
come on, that's at least a suite. Come on, bedroom. There's a dining room table behind you there. Come on.
I mean, it's an acid capitalist suite. It is Scotland. But the
bedroom. Look at that. He's living the life, people. Russell, the thing that disturbed me there was you've got a Bloomberg terminal. Now, I thought when hedge fund managers got out the game, they returned the Bloomberg terminal. Have you hung on to yours? Do you use it a lot?
So Bloomberg is the most scammiest business in the world. So I had like a business contract. And if you say, okay, I don't need this anymore, you then have to pay half of the remaining period as a break fee. And I was like, all right, fine. If I'd rather than pay that, I'll just take it at home and pay the remainder till that contract runs out. So I still got a bit of time left on that. And then I'm going to see what I want to do. It's quite expensive, but it does have some nice features. So
is it 20,000 a month for it? No, it's not.
No, it's like $2,000 a month.
A year or something. Yeah.
$2,000 a month.
$2,000 a month. So 24 a year.
Yeah. A little bit more.
Yeah, I had the same thing, I some damn secretary had signed some scuzzball fraudulent photocopying contract.
Oh yeah, this is what you had when you tried to shut your hedge fund. There was you had an outstanding debt where like it wasn't some client or anything. That was you had to pay off some photocopy company.
It was like, asking for $1 million. Like, yeah, because XYZ signed this contract. I'm like, what are we doing a mail drop to the world? I mean, what are you talking about? So it was that, and it was like you say, it was Bloomberg. I was like, oh my God.
But I couldn't believe how often we used to, back in the day, we used to get people just send through invoices saying companies we'd never dealt with, they just send through an invoice. I think what they were hoping was that some junior would get it and go, oh, I have to pay this. And then they just get the money. It's like, and they're like, no, let me see all the, no, we've never dealt with that company. Throw in the bin. It used to happen all the time. It's like a very innovative business model.
I remember sitting in a management meeting. I'm like, why are you spending so much on paper? And I was like, really? What? I mean, look, it's our second biggest expense. Detail, people. Detail. The problem Russ and I have is like, what's that Tom Cruise, Steven Spielberg movie where he's an agent, he's sent out by these kind of spongy people that lie in a spa all day, but they can see
Minority Report.
Minority Report, yeah.
And
yeah, we're in the spa all day, and outside contracts are coming in, and all mayhem is happening. But
can I ask you before we round up? I wanted to ask you about Julian Robertson. Now he passed away, and he was a bit of a legend in the hedge fund game.
I didn't know that, Chris. Wow.
Yeah, he passed away on Tuesday at his home at 90 years old. He said that he brought hedge funds to the mainstream, but he talked about his short selling. And Russell, you talked about how you'd done, you'd be able to short sell commodities, and obviously Hugh, you famously shorted the banks in 2008. So, what would you say about Julian's legacy and what you thought of him? I thought people might be quite interested because he's a bit of a big dog in the game, isn't he?
Yeah, I mean, look, the standard Julian Robertson model, as far as I knew it, was what you wanted to do is be levered long momentum winners and then offset that with a short position in momentum losers. So essentially, you never wanted to be far away from momentum. And you know what? And the weird thing is I always was a little bit chary of that type of model. But now, as I've been thinking more about the US in particular, the amazing thing about the US is how much power US corporates have over politics, way more than in any other country I've ever lived in or looked at. And so this model was really playing in the correct way of playing into politics in the US, I think. So you always want to be, and Warren Buffett's the same, is you want to buy these best companies. And it's a super successful model. Other than that, I didn't know him that well, or other than that, I didn't know how he made his money that well. Like, I don't know his big stock picks, but I do know like the dot-com bubble took him out. So he went short too early, which is always a big problem.
That model you described, and we've seen the failures of that model, because you're saying essentially, as you described it, my interpretation of what you described is you're leveraged volatility on both sides. You're directionally long, short, momentum with volatility, and when that works, it's rocket fuel. But you blow up. I always remember
Bill Huang was the exact
another protege.
Yeah. We've covered Bill in this show. Bill's a bit of a character, isn't he? Bill's a bit of a character, to say the least.
And Chris, if I may just correct you,
sorry,
I did not.
Okay, I know, but just for colloquial, I'm doing the air quotes. I know you did it complicated, but it's complicated to explain how you did it, because it's not nice.
It is complicated. It is correct that it's complicated.
I stand corrected. You do not short the banks.
I'm simply pushing back because shorting, I would not advise people to short. It's irrational because the rewards are the reward structure is not appealing, right?
Well, if you get it wrong, it isn't, right? But I mean, you got it right.
You have an infinite loss for the possibility of a finite gain. Why would you do that?
Well, I mean, if it works out, you can make a fair bit, right?
I want to make a bold claim. I don't think. I was going to say I don't think there were any, but I don't think there were a statistically significant percentage of the population of speculators who came out of 2008 because they were like positive for the year because they were short the banking sector. It was impossible owing to regulatory intervention, short selling bans, and the volatility that it created. That actually to get the gains, you had to have the wisdom to say it's not a smart investment and to try and procure that payoff return in a more complex manner. So,
no, I stand corrected. As I have, we've talked about Hugh's book about a million times, but in the book we do go through it, and Hugh is right. He did not short the banks. I meant that as a paraphrase. So I stand protected. I stand corrected, and I apologise profusely to the acid capitalist.
Well, we love you, Russell. Thank you. Thank you again for coming on. Thank you for being. I was going to say the fox to my tail. I think I'm the tail to your fox. I think I'm talking nonsense.
Two cheeks of the same arse. What about that? No.
What does that make you, Chris?
Well, let's not go.
Yeah, I think an apt moment to wrap it up.
Well, Rampaging Russ, you're Rampaging Russ on Twitter, aren't you, Russell? And also, you do your Substack. I think we mentioned it before, but your Substack's great. I watched one a few days ago when you sent it to me of when you compare your son's karting and you get into an idea about how you would invest in a hotel chain that you stay in and you go into the Bank of England. It's pretty cool. So you do have your own social media and commentary going, which people can check out.
And where did he find your Substack again?
Russell-clark.com is my Substack. And then whenever I run my Substack, I stick onto my Twitter. I do some stuff on Twitter, which is Rampaging Russ. But the Substack's a place to look. And generally, I just, like I said to Hugh at the beginning, is, I try and look at what the market's obsessing about today and then try and give it a bit of an analysis in the way I look at things and then write about that. And, and then, think about how things are going. And, I do, you guys were talking about short selling. I think the thing about short selling, which is where I went wrong, is you shouldn't be looking for shorts, right? You shouldn't be looking for companies that are blowing up. But I think every now and then when you're just working, you'll suddenly come across a scenario where it's like, holy smokes, this company's in this business industry. Industry is better. This industry is in deep trouble, and then you should short. It is not, as we used to say, shorting's for show, long investing's for dough, and that is.
I love that. I love that.
It is for show because people love it, and it's a great show. But long term, it doesn't make sense. But what I would say is, every now and then you get an opportunity when something comes along that looks so wrong. You can short it and make good money. That's the way you should look at short selling, is my view. You're muted, Hugh.
I'm sure you'd have found attribution of fund returns the biggest expense, hopefully, is the management performance fee, but closely followed by losses from short, and then fund expenses. It tends to be in that kind of order.
I had a lot of success with the short book, I must say. Because I spent a lot. My real problem was I didn't capture that massive bull market in US and tech stocks. That was a real problem, to be honest with you. Because the reality is most companies fail. I'll be honest with you.
Well, yeah, I mean, you look at the constituent stocks of the Dow Jones, the 30 largest companies 100 years ago, and then you roll forward every 10 years, and they all disappear to your...
I've got a wild idea. I'm going to melt your brain again, Hugh.
Well, here we go. Here we go. Melt away. So
your average hedge fund, and this includes the sort of Julian Robinson models we just talked about, what they'll do is they'll say, I'm a fantastic stock picker. I'm going to choose 10 stocks and I'm going to hedge with the indice, right? That is a standard industry practice. Indices will always go up over time just because they always getting rid of losers and buying winners. Real hedge funds, the real hedge fund model, which should be, I'm going to buy the indices and these are my 10 favorite shorts against them. And they should be, because then you're actually using the market structure in your favor. But actually the hedge fund industry as a whole tends to use the structure against themselves by constantly hedging versus the indice or using the indice as a benchmark. But the problem you've got there, and why no one does that, is when you go see investors and you say, yeah, I'm making all my money being long indices, they lose their minds and say, oh, I can do that myself, blah, blah, blah. So there's like this, that's the problem with that, the short selling thing. But that is where the real value would be, in being long indices and then short your stocks against it.
Yeah, I mean, the only thing is, you always want to load yourself with some advantages, and being long, you're long a risk premium. The market's saying this is an uncertain venture, and you're actually rewarded to a degree, either high or low, but there's a positive return from your engagement with risk, which if you're just exclusively a short seller, you default. You're stacking before you begin. You've tied your shoelaces together. Is an issue to be aware of. Warren Buffett's model is the best. You just long risk premium and long educated risk premium.
But that is something that Russell said about, people maybe thinking they can do it themselves or whatever. And I mean, that's something that I've noticed in this show. And again, I'm the idiot in the room. I'm here as the everyman. And I think the difference between what people know and what guys like yourself from the professional, I mean, it's such a huge jump. I mean, you guys can see things that I don't even haven't really thought about, or not that I'm particularly intelligent, I'm not. But I think a lot of people think they can dabble and do it themselves. But I think the difference between what you guys do and what people assume you do, I think is a massive knowledge gap in the mainstream public.
But two things. This is not investment advice. This is banter.
Yes, true.
And secondly,
regulatory warning.
Yeah. And secondly, it's quite a hard challenge, but I'm going to see if we can do something and try and collect a kind of greatest hits. I mean, we've been having this conversation, you and I, for over 2 years. And the things that we have had banter about, our success rate on banter has been without a Bloomberg and simply using free or very cheap internet sites reveals that it is not exclusively for... clearly, Russell and I have dedicated.
Yeah, but I mean, that's what I'm saying. I mean, you're doing most of the theory. Well, I mean, virtually all. When you and I are bantering, as you say, I mean, most of the gold's coming out of you. I mean, I did have a part to play in that Libya idea. To be fair, I mean, I did have a part to play in that. But most of it's you. I still think that's got legs. But anyway, we'll go on to another day.
Okay, listen. Let's wrap up. It's that time of the week where I wish to thank you for your kindness and your endeavors. The more that we can rate the show and leave comments, the more we can crack the Apple iPod system, and the more we can spread the message, create the positive energy. So thank you, everyone who has already done so. And if there's any more ounces of energy out there, if you find the time this weekend, if you could do a review of the show, both The Alchemist and The Ask the Capitalist, we'll love you forever. Well,
thank you, people, for joining us once again this week. That was Rampaging Russ, a.k.a. Russell Clark. I have been The Alchemist, or I'm under maybe you might think I'm Hugh Hendry, but I'm not. But I am The Alchemist, even though my hat says something different. And he's been Hugh Hendry. And next week, he's going to tell us all about what it was like to present. Does he go in a suit and tie to this big talk that he's doing in Edinburgh, or does he go St. Bart style? It's going to be interesting. We're going to get all the gossip about it and hear about it. Right, Hugh, you can tell us next week how it goes.
Chris, you are not only the alchemist, you are the chief disciple. Chris, you are not simply the alchemist. You are the chief disciple of the faith. Thank you, my brother. Tomorrow will be another day. Next week will be another adventure. But rest assured, you and I, we are going to do this again.